Hello and welcome to my channel. In today's video, I'm going to answer one of the most important questions that all of us have to ask at certain stage in our life. Whether should I buy a house or should I continue renting a house? There are multiple hidden costs involved in buying a house, which I'm going to uncover in this video. I'm also going to look at what is the return that one can expect after buying a house. So this is going to be a very interesting video where I'll touch upon some interesting costs which many people do not consider when buying a house. First, let us ask a question: why do people buy a house? First, people buy a house because it gives them a sense of financial security, which means that in bad times they have a place to stay. Secondly, people think that buying a house would help them build equity, which otherwise they would have paid in rent and the money would have disappeared. However, buying a house has got a lot of hidden costs, which we will uncover in this video. In this video, we will do a very simple exercise. We will look at the historical data for USA for the last 20 years, and we will estimate what are the sources of revenue for buying a house and what are all the possible costs involved in buying a house, and we will look at what is the net return that a person can expect on an average by buying a house. So let us first look at what are the sources of revenue. There are two sources of revenue when you buy a house. First is the appreciation of the underlying asset. That means that over long term, the value of the real estate that you have bought will increase. The second source of revenue for buying a house is the dividend income that you will get through the rentals. We will look at the specific math of each of these components in the subsequent slides. Now let us look at what are the cost components. The cost components can be broken down into two sections. One is one-time cost or the fixed cost, and the second is the recurring cost, which is the cost that you'll have to pay every year. So the one-time costs are costs such as the brokerage fee that you have to pay when you buy a house or when you sell a house, the transfer taxes that you have to pay again when you buy a house or when you sell a house, and there are other multiple registration and transfer fees involved that again you have to pay at the time of buying and selling the house. Now coming on to the recurring costs, there are 5 major recurring costs. The first and the most important recurring cost, which most people often forget, is the depreciation of the building component of the real estate. A real estate has got two components, the land component and the building component. The land does not depreciate with time, however the building which depreciates over the time. The second component is the interest cost, which is the interest that you pay on the money that you borrowed to finance the purchase of the house. The third is the annual maintenance cost, which means that the damages that happen to the property during the year you have to pay in order to repair those damages. The fourth component is the taxes and the insurance that you have to pay, and finally it's the property management fee. Whether you're managing it yourself or you're hiring someone to manage the property for you, there is a cost involved in managing those properties. Now we will jump into a very simple example to calculate the revenue and the cost. For the purposes of simplicity, we will skip the one-time costs. We will only focus on the annual recurring cost and the annual revenues that we can generate from the real estate. So let us start with the revenue. There are two components to the revenue. The first component is the long-term appreciation of the real estate. To estimate the appreciation of the real estate, we look at the data from 2000 to 2020 for USA. So looking at the annual average prices of houses in United States from 2000 to 2020, the average appreciation of the houses has been about 4.2%. We skip the data for 2021 as the appreciation for houses in 2021 has been abnormally high. So the long-term appreciation of the real estate would be about 4.1% in the United States. Now let us look at what is the gross rental yield. Looking at one of the research reports, we see that the annual gross rental yield for single family homes is about 8.4% for 2020. We will use this as an approximate rental yield for United States. However, this can vary based upon different cases. You might see a lower or a higher rental yield depending upon the location and the type of house. So when we add up the appreciation of the real estate and the gross rental yield, we see that the total revenue that the real estate would generate annually is about 12.5%. Now let us jump into the annual recurring costs. We will walk through all of these individual costs. The first cost is the annual depreciation cost. As I mentioned earlier, every real estate has got two components. One is the land component and the second is the building component. The building component is what depreciates over time. On an average, about 60% of the real estate value is comprised of the building component. And over the course of 30 years, you have to replace that building component again. So dividing the 60% of the home value over the course of 30 years, we get a depreciation rate of approximately about 2% of the total real estate value. Thus, our annual depreciation cost is about 2%. Now let us look at the interest cost. To calculate the interest cost, we make two assumptions. The first assumption is that you make 20% down payment. That means your equity in the real estate is 20%. And the 80% of the total equity is debt financed. That is the money that you have borrowed from banks at about 4% annual interest rate. So if you pay a 4% annual interest rate on the 80% of the real estate value, your annual interest cost is about 3.2%, which means that on a house of about $100, you would be paying $3.2 in annual interest cost. Coming back to all of our costs, now we'll look at the annual maintenance cost. The maintenance cost can vary anywhere between 1 to 4% of the total real estate value depending upon the age and the type of real estate. However, for simplicity, we will assume 1.5% of the total real estate value as the annual maintenance cost, which means that on a property of about $200,000, you would be spending anywhere between $3,000 annually on the maintenance cost, which sounds reasonable. Thus, our annual maintenance cost is about 1.5%. Now let us look at the taxes and insurance. In USA, the effective property tax rate is 1.1% of the average home value. So we use this number as our base case. So our taxes and insurance cost is about 1.1%. Finally, coming to the property management cost. Whether you manage the property yourself or you hire an external party to manage the property, there is a cost involved. And we will make an assumption of about 0.5% of the total real estate value as the management cost. Even if you're managing it yourself, your time has got some value. So for an assumption case on a property of $200,000, you would be spending about $1,000 annually to manage that property. Adding up all these costs, we see that the total annual recurring cost is about 8.3%. Now let us subtract the cost from the revenue. Subtracting the total annual recurring cost from the total annual revenue, we see that the annual return is about 4.2% of the total real estate value. However, this 4.2% annual return is the return on the total real estate value, and your equity in the real estate is only 20%. So we need to look at how much return you are making on your equity rather than return on the total real estate's value. So to simplify, on a property of value about $100, you invested only $20, and the value of the property increases by $4.2 each year, which means you get a very good return of about 21% return on your $20 investment. However, in making these calculations, we had made several assumptions, and those assumptions have to hold true in order for you to make these returns. So for example, we have assumed that the rental yield is about 8.4%. If in your case the rental yield is super low, then probably you might not reach this return, or if yield is higher than 8.4%, you might even get better returns. So you need to watch out for all of those assumptions. So what is the conclusion that we draw from this analysis? A debt financed home ownership for long term gives you a good return on your equity. However, if you finance the home ownership through 100% equity, then that might not be a good investment in terms of the returns that you would expect compared to other investment opportunities such as the stock market. I hope this video helped you in gaining a new perspective on home ownership and what are the factors that you should consider when buying a home, and you can definitely play around with those numbers and make your own calculations to come up with what is the return that you can expect. Thank you.